Hello and welcome to the Wendell Effect. My name is Brandon Wendell, and I'll be with you for the next, well, however long it takes to get through. I want to welcome everybody back for this video, and hopefully you enjoy this. Before we get started, I just need to put out a couple reminders here. And just to remind you that we're not registered broker-dealers or investment advisors. We're taking a look at all this information from an educational standpoint, not telling you to buy, sell, or hold anything in particular. And keep in mind that all trading does have a risk of loss. This is always a situation, no matter what we do, to try to minimize the risk. And past performance is not an indication of future results. So that being said, let me go ahead and change the size there. And if you want to stay in touch with us, you can obviously find us on the tradingmindsetassociation.com. You can email me at the Wendell Effect at tradingmindsetassociation.com. Follow me on Twitter at TraderBDub, and don't forget to like and subscribe on YouTube for the Wendell Effect, which you are in right now. So for today, I'm going to start off as usual, taking a look at the weekly market analysis on the U.S. equity index futures, popping on over to the energy futures, and then we'll take a look at sector analysis to get an idea of what might be moving the markets and where the opportunities might be lying. We'll take a look at the Indian markets for my friends overseas, and for chart school today, we're going to go ahead and check out Fibonacci and take a look at different ways of using the Fibonacci analysis to find probable turning points in the markets. So we'll go ahead and just jump right into it. And again, with the equity market futures, equity index futures market, for the week of May 15th, here we go. As far as the ES, we had a pretty significant bounce, but as you can see, the 39.05 was an area of demand that had been identified in the Wendell Effect videos. Honestly, I identified that many weeks ago, as well as other things like on my Twitter. So not really too much of a surprise. We had a pullback at that area. It's not the strongest of zones. It doesn't change the overall trend. We're still in a bearish trend, and we would need to confirm that we're going to start turning around a little bit by getting a break above 4,100 this week. If we can get a close above that, especially, that'll be very bullish. But unfortunately, I think all we're going to continue to do is make lower highs long term. So while we might get 1 or 2 bullish weeks out of this, overall, we're not out of the woods yet. And the reason why I say that is looking at that RSI, we got a lot of momentum still to the downside. So even if we move up, the only way we're out of the bear market, first of all, we would normally see some sort of a divergence there first to let us know when we're done moving down. And then also, as we rallied, we would actually go above 60. And that would tell us that we have enough bullish momentum to maintain a move back upwards. So we're just not getting that. We haven't had it all year, as a matter of fact. We've pretty much been down in the doldrums there, and it's just getting worse and worse for the bulls. It's better for the bears. You can see the projection that I had from May 8th, which was last week's video, was actually pretty much hit. That 38.50 was the area that I was using as a target. And on the daily chart, you can see we bounced off that on Thursday, and Friday it came right back up to the previous target. Not that that really has any meaning there. We're on a retracement now, so we should be using the retracements, as you can see here, to tell us where the stalling points and maybe the continuation of the downward trend would begin. So we stalled out at 23.6 retracement. That's our first retracement area. Excuse me. Then we continued on. As you can see, we finished the week just pulling away from the 38.2% retracement. So if we go any higher, the big key will be if the RSI could stay below 60. If we end up making lower lows, which technically we did on Friday, we made a lower high followed by a lower low, that kind of confirmed that inverted hammer candle and may resume our bearish pressure come Monday, but and overall for the week. And that'll keep us below 60, which means we don't have enough bullish momentum to continue up to the next retracement value. If we can get it back above 60, that's the only time you're able to make new highs. And as you can see, we've had previous highs here at about 40.75 or so. So we're going to probably stay below that area unless we get momentum picking up. Let's see. Oh, I'm sorry. This is labeled wrong. It's supposed to be the NASDAQ. It is actually a NASDAQ chart labeled as the S&P weekly, but it's the NASDAQ weekly. Pretty much the same thing. We stalled just shy, and that's because we hit targets on the other markets. So that's why we didn't hit it here on the NASDAQ. But as you can see, still pretty bearish. We went a little bit lower than we had previously on momentum, so that's sustaining the move downward. And once again, we'll just watch to see if we can break the high. If we can't, then we're continuing to move down. If we do, again, we're not out of the woods. We're still making overall lower highs and lower lows, and I don't see any signs of retreat yet, at least not for next week. We're still going to be in bearish trend, even if we do get a little bit of a pullback. And this is, again, the NASDAQ daily chart, not the ES. I apologize for the mislabeling there, but you got the moves to the downside still. We did retrace on the daily charts here up to 38.2%, but we are still extremely weak. And that's all this really is just a retracement. We're likely to continue to fresh lows before the end of next week. Looking down the 240, again on the NQ, not the ES, ignore the label, look at the actual chart. You can see that we've just pulled back, like I said, a 38.2% retracement. We kind of a tweezer top here where you have almost the exact same highs, but been rejected from that area twice. So we could still keep going up, but most likely we're going to stall out either at this level if we break to new lows, or we'll stall out the 50% level and then continue to impulse downward towards the end of the week. On the Dow, that one's labeled right. We got pretty much the same picture. So same thing, bearish trend altogether. Looking at the YM on the daily chart, you can see we did have a divergence. That would be one of the first signals that things are getting stronger and that the downward trend might be dying off. But what happened after that is as we retraced, we failed to barely even get above 50, let alone 60 on our momentum indicator, the RSI. And since we couldn't do that, couldn't get into bullish territory, the bearish trend took over, and you see we broke down lower at the end of the week. Actually, not even the end of the week, beginning of the week on Monday right there, we broke below that trend line, and that told you we were going to be bearish for the week. So keep eyes out for those types of things. And right now, even though we're retracing, it's a very weak retracement altogether. On the 4-hour chart, you can see that we get lots of little warning signs from the momentum. We tried to move up after divergence, as I said, but then at the beginning of the week, we fell down. And as soon as we went below 40 again, the bears were back in full force. So we're struggling, and we probably will, we could possibly peak above 32.5, just right above this high, but I don't see us doing much more than that. This is kind of following now. The Dow's a little stronger than the NASDAQ and the S&P, but altogether still looks very, very bearish. Moving on to the Russell, it's pretty much the same thing. We overextended past the Fibonacci extension, so we really see lots of bearish pressure here. Almost well, it didn't quite hit the second target. It passed the first one, let's put it that way. But it's pulled back with the other markets, of course. You can see that retracement. Actually, this looked a little better for the extension down on the impulse correction. So we did hit this target dead on, and we are still extremely bearish, only getting a little retracement. We might get back to fill this gap around 1840, but I don't see us going much further than that to the upside. You can see that 1840 area is right in here. There's that gap we saw for the weekly and daily. Now we're on the 4-hour. And that's actually kind of a zone. Not really great, though. We kind of paused before moving down yet again. Overall, though, still looking pretty bearish. We've only retraced 38.2, just like we did on all the other markets. And that may be all we end up getting. We might not be able to move down much more or much more than that, and look for continued selling pressure towards the end of the week. We might get a little bit more momentum, but overall, again, we made the lower high and lower low here. I just don't see a lot out of this. Moving on to the energy markets, we'll take a look at how they're doing for the week of May 15th. And we're going to start off with crude oil, which has been moving in kind of an ascending wedge. You can see it's consolidating kind of flat on top, but the higher lows have been coming in. This looks like it wants to break, unfortunately, to the upside, which is going to be kind of inflationary. We'll see if that actually happens. Momentum is dying off just a little bit, but that's normal when you're going to consolidation sideways. On the daily chart, you see it even better, where the highs actually have been dying off a little and making higher lows still. So the momentum has gone between 40 and 60, which indicates sideways motion. You don't have enough bullish momentum to move up. You don't have enough bearish momentum to trend down. So you just kind of consolidate a bit sideways. But with all this consolidation, typically you break in the same direction you came in, which would be upwards. Now, we had a very shallow move up on our way in, so I don't expect a big explosive move to the upside. I expect this to be kind of a weak move up out of 113 to surpass 120. Looking at the 4-hour, again, not much going on there. It'll be interesting to see, though, if we're done and we break out of this, or really what's happening right now, we have about the same momentum we did before, so we may be making another move to the bottom of this upward trend line. So we'll have to wait and see what happens on Monday or Sunday night into Monday, really. And if we go ahead and see that there's some bearish pressure, we make some lower lows and lower highs here, expect to go down to the bottom and possibly bounce off the trend line once again. So that might even be an opportunity to buy if we can touch the trend line just a little over 100. And then if eventually we'll expect that breakout to the upside, take us possibly even above 120, unfortunately. On the weekly chart of Nat Gas, had a crazy candle. It looked as though we were going to start dropping dramatically, and we moved all the way from 8 down to about 6.5, a little under that. And you can see we had a lack of momentum, and that's why. So we had higher highs in price, and we had lower highs on the indicator. That's our negative divergence, which usually leads to a pretty good pullback. And we started having that already. So it's not a trend change, it's just a correction. So there's still bullish pressure underlying. Although we may not be done with our move back down, we're actually making this giant head and shoulders, which I didn't really label here. That's a left shoulder, head, right shoulder is forming right now. And you can see we couldn't get above 60. So we may be pushing back downwards very soon to at least 6.5. And if this is a head and shoulders, where this would be our neckline around 6.5, the measured move is usually the height of the head. Oops, I didn't mean to go forward there. But the height of the head down from the neckline would take us to about 5.0. So it is conceivable that we break down. Now we do have a little bit of demand in this area. Looks like we have nothing right there, but we have a rally base rally right around 5 3/4 to 5.5. So if we do start making that lower high and lower low right here, potentially on the daily chart, we could break down. Looking at the 4-hour time frame of the same security, you can see that we've come into a 4-hour zone. And we had pretty much, drop, base, and drop. So lots of selling pressure coming in here. We came into that area, stayed below 60, so we didn't have bullish momentum to carry us upwards. And now as we move down, we've already confirmed on the 4-hour chart with lower highs and lower lows. We just need to see it on the daily. First target to the downside would be 6.771. Second target, 6.062. Onto the weekly chart of gasoline, we have moved to the upside, but we're losing momentum badly on that move to the upside. Okay, so as I said, with the momentum dying off, we might have that move down. You can see we did break out of our consolidation that we were in on the daily chart as we expected. It's kind of like what I'm showing you on the crude oil right now, where you have that consolidation. After a rally, we should break to the upside, and we have, although we are losing our momentum now, so it looks like we might get a pullback pretty soon, and we'll just have to wait and see. On the 4-hour time frame, looks pretty good. If we do get a pullback, that's all it's likely to be. We could keep going to the upside, especially if crude oil keeps going up. And we've got basically demand there at 3.8 as well as 3.6897. So keep an eye out for those opportunities on the pullback there, if possible, for a long opportunity to buy. And actually, you know what? While I'm thinking about it here, let's go ahead and I'm going to go back right here. You see, I've got the I paused myself in a weird spot there. Anyway, on the YouTube, the Wendell effect. Don't forget, if you can, go ahead and like and subscribe as well. But one of the comments that came in here, I just want to take a look at this. This is awesome. But you see right here, excellent stuff, Brandon. Really appreciate your analysis. I want to thank you. Yurav. Is it possible to show a sample trade you usually take based on the analysis? Like a daily trade with stop and loss and profit take would be? Yeah, let's take a look at that. So if I go to my charts, again, we're on the 4-hour here, crude oil, or sorry, gasoline. Let's take a look at that. Actually, let me go back. I'm right here, and we'll go RBM 2022. There we are. So I go to the 4-hour time frame. If I'm planning out this trade, especially if I'm looking to buy at this area of demand, first of all, we have these extensions that have already been used, or we're kind of at that target right now, waiting for it to pull back. So that's not going to be usable anymore. We're going to talk about Fibonacci at the end of this video today. So if I'm looking to buy, first of all, there's a couple different ways of placing your stop loss. Personally, I don't really give a lot of wiggle room for these. If the zone's good, it should hold right away. If the zone's not good, I just want to get out, obviously, and spend my money somewhere else, lick my wounds and move on. But right here, I usually place my stops just a few ticks below the zone. That's it. So if I have a zone right now, 37673, we can do 37600. Excuse me. And there we go. I put my stop. I'm sorry, 70, not 00, 70. Let's get that right. Now, when it comes down in the area of demand, I've got two choices. One, well, actually, I haven't figured out the target yet, so let's do that real quick. As far as the target goes, I'm going to go back to my trend time frame, which is the daily chart. And the reason why I use that, first of all, on the daily time frame, and let's go ahead and change this to make sure you understand that I'm on that time frame. There we are. So on the daily time frame, I'm using this to figure out what trend we're in. Is that trend going to continue? And it looks like it's going to. This is a very strong bullish trend. We had a pullback. We'll probably experience another one, but we're overall moving to the upside. Now, where's the trend going to end? That's a function of the higher time frame. I've talked about multiple time frames before, and I'll do it again, obviously. But from the daily chart, I would look at the weekly to let me know where that trend's going to end. So right now, it doesn't look like the trend wants to end yet. We still have a little bit of divergence. As you see, we're starting to weaken a little bit, but we have some potential movement to the upside still. So I'm going to use Fibonacci extensions, which I will talk about later today in this video. There we go. I'm just make sure they're snapped to the right mode or right area. And that should tell me where the end of the uptrend should be. And the reason why I'm doing this is, number one, that could be my second target. Number one, that's my second target. Number two, that is going to tell me where the trend is likely to end. So I use the higher time frame zones, or in this case projections, to let me know where the trend is going to end. And I want to make sure I'm not close to the end of that trend, so I still have room to go for my trade. Okay, so that's what I look for there. I go back to the daily chart. I verify the trend is still intact and that we don't have any problems. We're good. Now I go down to the 4-hour chart and we plan out the rest of this trade. So let me hit refresh there. And I've already got the entry. I want to mention my target and my entry. Target number one hasn't been shown yet. Target number two, I've already got up there. So I got to figure out target one. Normally, that would be a zone on this time frame. Well, I don't really have any zone on this time frame, but I can create one by using the Fibonacci's on the most recent impulse up. So hypothetically, we don't know if that's going to be the end of the move, but if it is, that's my projection up, and there's my target number one. I'm going to change the color on that as well. So, not template, I'm going to go settings and style. There we go. So I'll change the color so we see that differently. Perfect. So now I've got target one, and then target two, I've got a choice. I can stay on the same time frame, or I can target the higher time frame area. So basically what it comes down to is I have that higher time frame, which I like to call the perspective time frame. And I'm using that to figure out where trends will end. Okay? And then on the intermediate time frame, which I call the trend time frame, that is the direction to trade. Tells me which way I'm going to be trading, up or down, or if I'm going long or short. And then on that lowest time frame, I call that my zone time frame. That's basically entry and target one, and of course stops. So that's what I'm using the three different time frames for. So as of right now, what I've created was I'm going to go long on the 240-minute demand. Okay, stop loss below the zone. I'm going to be target number one, place that at the first projection. And normally it would be the first opposing zone on the zone time frame. That's what I would normally use. But again, I don't have that right now because we have new highs that we haven't reached in, well, ever. So I'm going to be using my first projection on that higher time frame. The first opposing zone is what I would normally use. And my target number one is we just went over that. My target number two is the end of the trend. So basically, in this case, I'm using the projection from the higher time frame. Or I would use a zone on the higher time frame in order to get out. That's it. Now, once I get halfway to my target, I start using trailing stops, and I'll talk about that another time. I'm not going to get to it right now, but you got to have some sort of a trailing stop system set up. Now, the other thing I can also do for the stop loss, if I choose to, is use an average true range or a percentage of the average true range. A lot of people like to do that. So I just use a couple ticks beyond, but as I said, an alternative stop method is a percent of the daily ATR. It's really up to you, but a lot of the ones that I've seen before being used would be if you're trading on a 240-minute chart or larger, use 10% of the daily ATR from the zone. And if you're using less than that, I have there with alternative. Did I spell that wrong? No, it just says the alternative. Anyway, that's fine. Grammarly's trying to correct me here. Anyway, if you're less than 240-minute, use 2% of the daily ATR. Whoops. There we are. So anyway, that's what you can do for a trail stop if you choose to. I'm not going to go into that detail right now, but I'll do it maybe next week. So that's it. I've now got my ideas of where I'm getting in, and I can either enter as soon as it gets down to that level, or and place my stop and target 1, target 2, like I said. Or what I can also do is I can wait as it comes down to that area. If I want to wait to get in and watch it, I can actually go down to a smaller time frame and try to fine tune my entry. Okay. So we'll talk about that on another session, I think. But right here is my entry to the trade. Again, I've got the stop loss. Close out that ad. It's up on Brave there. So I'm going to stop right there. And as I said, target 1 is right here, which is on my zone time frame. I just use a projection. And then target 2 is pretty much where I expect the end of the trend. And that's determined from that higher time frame. That's it. So there you go. So we'll get back into more lessons in another session, but I just want to kind of take a little pause there and go over that and just kind of walk you through a trade. So, thank you for bringing in the suggestion. And as you can see, I love those suggestions. I love to give you what you want. So we'll continue on here. Whoops. Heating oil weekly chart, got a negative divergence, might get a pullback soon. And on the daily chart, we are already pulling back a bit. As you can see, we're having some struggles going anywhere right now. We're just a bit sideways. There is demand, but it's been a lot of time spent there. So we could find more weakness and move down. I forgot to mark off this demand zone drop base rally at 3.2. So if it doesn't hold, which we could, when we base like this before you reach a zone, that's usually because you want to break through it, or price wants to break through. So potentially we could break through this area and go all the way down to this 3.2, which is a pretty good zone. It's a much better zone, I think, because it wasn't there as long. On the 4-hour chart, you can see we had a false break. That's why I'm very cautious. When you get breakouts of consolidation like this, first of all, you should normally break in the direction you entered. And you could see this tried to break in the opposite direction. That's your first warning sign it was a fake breakout. The other one was we didn't have enough momentum to sustain that. You went out, you didn't go outside 40. You didn't have enough bearish momentum. So it was a fake out, came and bounced and went the right way. Anyway, right now we are seeing a lot of weakness here in heating oil. This might actually drop to that 3.2 area. I don't have a good entry yet. Maybe if we break down below this 3.8 because we're making lower highs, we need to make a lower low, and then we can start looking for entries. But we see we cannot get momentum going, and we are getting a lot of weakness. So we might push down to that 3.2 area pretty soon. On to the sectors, and looking at the hot stocks and hot sector, right now, pretty much not much has changed. We still see energy as the hottest sector. We got staples close behind with utilities as well. This is all defensive in the sector rotation model. It's a very defensive play that you normally would see when people are expecting the stock market and then the economy to slow down. So people are still trading for safety right now. Now, this is how they performed against the S&P 500. You take out the S&P 500, energy's still bullish. Utilities not so much, but it still is, and so are staples. Again, it's a flight to safety. That's what we're seeing right now in the stock market. So looking at the XLE, see we had a pretty good pullback. However, we're struggling to get back up. I mean, the next target is that 61.8 extension that we have here, but we need to be able to go above 60 and get that bullish momentum to actually make it above that area. Looking at the energy sector last week, this is the results for the week. We only have one positive, and that's Baker Hughes. Everything else was on the red side. It's kind of crazy, but that's because nothing else recovered from Monday's collapse in that sector. You can see that sector itself barely got up. So looking at that Baker Hughes, you can see that that one Monday was already down a bit, or so it didn't really drop much, and that's where we climbed out. But we're failing to get into bullish territory. So if the shining star of the sector can't go any higher and starts to fall back, you should expect the rest of the energy sector to actually have a weak. I should say a bearish week, honestly. That's what it is. Moving on to utilities, which are also enjoying a bullish move. You can see they were only led by a few names here. So we didn't have everything moving up. You have Xcel Energy, Con Ed, I think that is. Ed, I'm not sure. But some of these were good, but not the whole sector. So without a huge participation, you got to wonder if that's going to be able to continue to the upside. And looking at the XLU, it's just choppy. It doesn't look very good for the utility sector. We are kind of flattening out. So it looks as though kind of sideways motion. We're just flatlining kind of behind or below that area of supply. I don't see us moving much in either direction, to be honest with you. It seems like it could be kind of a look somewhere else for opportunity type of week. In NRG, which was one of the bullish stocks in that sector, NRG Energy, you can see that this one, if we do pull back on the week, it's because this has been relatively strong. It's actually going to be setting itself up for one of my favorite strategies, which is called my 889 trading strategy. So look for that as a possibility to buy at the 41.22 with the stop loss at 40.70. Target number 1 is 42.63. Target 2, 43.50. We're reaching up to some new highs, so I went to book some profits a little bit early there. But this is on an hourly chart, so we could get that going pretty early in the week, which would be kind of nice. Moving on across the pond, well, not really across the pond, it's the other side of the world for me, but into India. And on the week of May 15th, you can see the Indian Nifty is very, very bearish. We're getting ready to make a fresh low, and we will. This has no momentum to the upside at all on the weekly chart. We're ready to collapse down below 15,000, which would be a big psychological number. I'm sorry, Lucy's barking in the background there. So you can see on the Nifty chart, we came down to this area of demand on the daily, and it won't hold. It's been tested before. We got way too much bearish momentum. I'm looking just under 15,000 for where we're going to pause, 14,749, and maybe a little under that as well. So that's what I've got going on so far on the Nifty. On the 4-hour chart, we just had a small pullback with that divergence, but overall, this is not going to hold. So we retraced only 23.6. We could retrace more, but I just don't see it. I think this is just going to be pushing to the downside. I'm going to be looking for selling opportunities. You take a look at Reliance, which is the leader, and you can see it had a negative divergence before we collapsed. And not only did we collapse, earnings didn't help either. You can see earnings were out last week. It just kept going. The nearest area that we could possibly even stop is 22.46. So that should take us through some of that demand on the Nifty itself because the Reliance is the heaviest weight. On the 4-hour chart, if we do get any kind of retracement, honestly, I'm looking to sell 26.0155 to 26.39. That looks like a selling opportunity with a stop above targeting 22.46. So that's what I see going on there. And like I said, where the Reliance goes, pretty much the Nifty is going to go too because it's one of the heaviest weights. It is the heaviest weight and the biggest influence. Moving over to the Bank Nifty. Did I do that? Yeah. On the Bank Nifty, looking pretty bearish, it looks like still. Same thing. We're getting ready to make some fresh lows we haven't had for a while. This will get pretty bearish once it gets below those previous lows. I don't see us stopping very easily. Maybe at 30,000, but ultimately 24,809 is where the real buying pressure comes in. So we might stall out a little bit at this prior low, just above 30,000. But other than that little stall, we should go down. On the Bank Nifty, you can see there's no fresh demand until 25,891. So we've been here before. We've eaten up all those leftover orders, and there's nothing to hold prices up. It's going to collapse. Okay, so for this week's chart school, I decided to go to Italy. Now, this is actually an Italian visit that I did quite a while ago, and that's me with Fibonacci, Leonardo Pisano Bonacchio, or Fibonacci as is more well known, back in, I think it was the 13 or 1400s. I don't remember, it was a while ago. But he was a mathematician who traveled the world with his father, was an emissary, I believe, for Italy. And he was in different Arabic nations visiting. Anyway, he came across this phenomenon that is now known as the Fibonacci sequence. He didn't actually discover it, he rediscovered it. So, but he did something to get his name on it. Anyway, what it comes down to is we're going to be looking at things like impulses versus corrections in price. So when you have an impulse, and you can have impulses up or impulses down, it just depends on the trend direction. So when you're looking at impulses, those are the sharp moves in the dominant price direction. So in this case, I've labeled them in green because when you're in a move to the upside, those smaller moves up are the impulses. Or if you're in a correction where you're moving down, there are impulses in the correction in the opposite direction. So they're the most violent moves. You usually get the biggest candles. You'll see large candles moving in the direction of the impulse. And if you get gaps, they often move in the direction of the impulse as well. So that kind of hints that that's where you are. So you have an overall impulse up, but then you get the smaller pieces in there. The corrections are slower moving. They consume more time. They don't cover as much price action either. So you see, we overall had an impulse up, correction down, but even the smaller pieces inside of the impulse can be measured. Everything can be measured, by the way, impulses and correction. So Fibonacci's sequence of numbers starts off with basically 0 and 1, and you add the number to the preceding number. So I'm actually missing a number there. Because 0 plus 1 is 1, 1 plus 1 is 2. 2 plus 1 is 3, 3 plus 2 is 5, and so on and so on. But that's the sequence. And Fibonacci identified a lot of different sequences and things with these numbers. And basically, the ratio of any other number divided, it should be, I'm not sure what that is, but anyway, at the ratio of any number divided by the preceding number, not sure what that thing came up as, but it's basically 0.618, and it alternates on either side of 0.618 and as it gets closer and closer. 0.618 is known as phi, or the golden ratio. Okay, but what happens is we have certain ratios that are very important to us in the financial world because we see them over and over and over again. The most important ones are in that purple color. You got the 0.382, 0.5, and 0.618. However, you also have 0.236 and 0.786, although a lot of trading platforms use 0.764, which is the inverse of 236. Okay, if you take 100 or 1.0 minus 0.236, you get 764. There are a few other numbers that are not as common. I know that some traders use 88.1 and just a few other numbers that are out there. But like I said, the most common numbers, the one that seems to work the most is the 382, 50, and 61.8. So those are used to measure corrections. Okay? You use retracements to measure corrections. We also have extension ratios. And those extension ratios, you saw me using them in the video earlier. You got 0.618, 1.0, 1.272, and 1.618. Then it goes to 2.618, 3.618, 4.236. Okay, so those are the numbers. Sometimes you can use 1.382 as well, but they're not as common. So I try to stick with the more common numbers. And those are used to measure impulses. So we measure corrections with retracements. Impulses, we use projections. So as an example here, you can see we had an impulse up in price. Doesn't matter what this was or when it was, but you see a big move up, and we are now correcting down. And you can see prices will often pause at some of those retracement levels. Okay, so if I go out to a live chart, let's do that. I always like looking live. Well, we can use this, the gasoline trade that we were just looking at, right? First, I'm going to clean it up. Okay, and we can see if I go to a bigger picture, we have impulses and corrections, right? So we had an impulse up right here. That's an impulse up. correction down. Although, maybe we can fine tune this a little more and say this was our impulse up, correction down. Either way, it doesn't matter. I'll start off with this. What you'll notice with the impulse up that I'm using, I don't have my snap mode there. I want to get accurate numbers. There we go. Notice I didn't go to the bottom of the entire move. Okay. When you're measuring corrections and you're measuring the impulse, I typically go from the open of the candle that gave you the move to the upside. And let's see, there's retracements. And you'll see that, well, we bounced at 38.2, but couldn't stay there. Ultimately, we turned right around 50%. Okay? Now, what if I had gone to that lower point? You notice we're kind of in limbo here. We're not anywhere near like we were on the earlier one. Okay? So, like I said, typically I ignore the wicks if there's a big wick sticking out, and I would go to the body, or really not the body, the open of the candle that gave you the start of the impulse. And that gives you a little more accurate measurements. So it's not exact. Okay, you got to realize Fibonacci levels are giving you the area where prices are likely to turn, not the exact number. Sorry, my dog keeps barking in the background there. So continuing on here, let's see. Again, another example, we have an impulse down. Notice the sharp movement down and the shallower correction up. Ultimately, paused a little bit here at 61.8, but ended up going all the way to 76.4 in this case, and then started a new impulse down. So I can look for something that's trending downwards. Pretty easy. We can look at the stock market right now. And you can see that currently we have an impulse down, correction back up. And I use the start of this candle, the red candle that was taking us to the downside. That's the opening price. And we are currently retracing and hanging out around a 38.2%. So that's what we can do when it comes to retracements. We are looking, corrections or retracements. We're using the retracement tool to measure the correction, where the correction is likely to end and the new impulse is likely to begin. The reason why we do this is we want to trade the impulses, right? The impulses are the faster, bigger moves, and they're the ones that usually make the most money. So we want to get in as early as possible when it comes to the impulse, and we might have multiple zones that we've identified. If we can find correlation between a retracement level lining up with the zone, that gives us higher probability that zone's likely to work. So it allows us to enter in the direction of the overall trend during a pullback. And that's what we're looking for. So here's an overnight impulse, same thing. You can see the impulse down, correction back up. In this case, I didn't have an extreme wick, so I did go from the exact high to the low. Okay, but when I have those big wicks, I ignore the wicks. And you can see we did a 61.8% retracement. Didn't quite close the gap. We hit the retracement level and then pushed to the downside. So you can do that. If I go into stocks, let's see. Chevron. Just picking random stocks here, doesn't matter. And if I go to a different time frame, I'll go to a daily chart. Well, we had a pretty big impulse there, started correcting down. So once again, I can start off. There's a wick there, so I can choose ignore the wick and go directly to the open of the green candle starting our move up. Honestly, we had some interruption here too, so it's probably best if I go to the beginning of the uninterrupted impulse up, right? Because we really were stumbling right here. So by ignoring some of those wicks and going to the open of that candle that took us higher, look at that. We hit exactly at 50% on the retracement before we started impulsing up again. Unfortunately, we didn't make a new high, and we started impulsing down possibly. But you can see that I get a little more accuracy if I place these in the right spot, which is the beginning of the overall impulse. Could it have worked if I went to the absolute low? Yeah, in this case it did. It gave us a 38% retracement, but not exact. It was much more accurate using the open of the candle that started the kickoff of the impulse. Let's say Tesla, that's a popular stock. Again, if I go on a weekly basis here, well, right here, we have an impulse up, starting to stumble right there. You can see we're starting to break down and pull back. Clean this up. And if I use my Fibonacci extension from the open of that candle to the high, now you can see we're stalling somewhat in the area of 50% retracement. It didn't hit exact, unfortunately. And What I really like to see is a zone that lines up, and I don't have one. So you can see we stalled in the area 50%, wasn't exact, and now we started breaking down even further. And unfortunately, we're impulsing down now rather than impulsing up. If you caught it early enough for the impulse change and the trend change, by the way, we can identify the change in trend from that higher time frame. Okay. So if we caught this moving down, let's see. Yeah, we closed at 61.8. We violated a little more, but couldn't really do anything there. Again, new impulse down, new correction coming. There's your impulse down, correcting back up, 50% retracement, and impulsing down again. So that's how you use these. You can also confirm by going into smaller time frames. I'm on the daily, and maybe if I go down to the 4-hour chart, when we come into one of those zones, if there's one of these retracement values, you can either short or buy at a retracement value, placing your stop at the next value, or you can look to see if it lines up with a supply or demand zone. So in this case, what I would look for, let's say I'm looking to go short again, because I'm going to continue that downward trend, right? As we get up towards some of these levels, I look to see, is there signals or signs of weakness? So right now we come up to this 50% retracement value. I see that we're having trouble getting above 50 right there. And if I go down to a smaller time frame, like a 240 or even a 60-minute time frame right there, I put in that vertical line and let me know where it was. There it is. As we were coming into that level, remember that's the day, so it's the entire day right here. You can see there's our signal that prices are getting weak. We finally made a move into the Fibonacci level, made a lower high, and when we made the lower low as well, pretty much did it right there at the same time. Lower high, lower low, that was your trigger to go short because we're at the 50% level. Your stop loss for that short could be the next level up here, and we would look for extensions for our targets. So you got to be careful, again, with the myths and realities. There's a lot of different ways that people have used these Fibonacci's in the past. You don't always have to start from the extremes, highs and lows. I start at the origin of the strong move, and it's usually the open of the candle, as I was showing you. So again, bear trend, start at the origin of the strongest leg down, or for the bull trend, you start at the origin, that's the open of the strong move up. You can adjust for channels and sideways movement. You can actually subtract that channel out of the movement. Okay, it gets a little more advanced, but that's something you can do as well. Ignore spikes. As I said, I just ignore spikes. I'm looking for the significant price action and where we're going to be moving and opening and closing. So adjust your base to align with prior support and resistance, or supply and demand, whatever you want to call it. Okay. And levels are confirmed if they've respected fibs in the past. You have a higher probability of the securities respecting these fib levels on previous measurements if they do it again in the future. And what else I have here? For morning reversals, you can actually use some of the overnight price action to confirm Fibonacci levels. I forget if I had a picture there. This was just showing from the highs to the lows, or from the strong recent move. And the strong recent move is usually better. But this doesn't really show it. These are old slides. I have to go ahead. What was I looking at here? Trying to remember because it was a while ago. Anyway, I'd rather go out to live charts so I know what I'm talking about right here. So if we go down, let's say to a 60-minute time frame here on Tesla, again, looking for impulse versus correction and where the new impulses are beginning, you want to get a good picture of the overall trend, and that's where you can start seeing the impulses and corrections a little better, by the way. If you zoom in too much, you notice it's much harder to see everything. But zooming out, you're just looking at overall moves. That's it. So right here, we had another impulse, and again, I'm ignoring the wick, and there's the move down to the low, and therefore it should get more accurate retracement levels. Okay. Impulse down, starting to correct back up. From that move down, looks like it went all the way to here. That's our impulse. And look at that, 38.2% correction. And we're starting to move back down again. So it works on pretty much any security, as I mentioned before. I can even use it on QQQ. That's almost the exact same chart, actually. I should probably do something else. I think it was this one. I was looking at this the other day. Somebody was asking me about it. ARKK. Actually, it looks about the same as the NASDAQ as well. There's this same impulse down and the correction to 50% retracement. Again, I've noticed I'm ignoring the the wicks and using the bodies of the candles. So if I just go to a random spot, here we go. And look at impulse down with the gap as well. See if this one worked. Didn't really work. Unfortunately, they're not always going to work. You can see we end up correcting in between levels here. Okay. And then started to move back down again. So we got another impulse and correction. Let's just move down to this one. Again, right there, impulse down, correction up. Now, I'm not going to remove the gap in this case because it wouldn't help. Really don't have much of an impulse there. But this one, you can see with that gap down, again, if I go directly to the open of the move down, technically, that green candle was a move up. So the gap itself should be ignored in this case, and the open of that candle moving down, look at that. It actually worked better, didn't it? So instead of trying to do this, which didn't give you an exact measurement, notice with the gap, I ignored the gap and go right to the open, and look at that. We've got a much better measurement, 50% right on the dot, and things started moving down. So let's go back to that previous gap. There it was. And I think it might work out better, again, if you go from the open of the candle down, look at that, exactly at 78.6, and we move down again. Another gap down. As you can see, that one retraced more than 100% of the gap. And believe it or not, you can actually do the bigger retracements back. 1.272, 1.618, and there it was. We hit the 1.272 before moving down again. Kind of crazy, but it works. So that's a little bit on the Fibonacci. And this is showing with dealing with a channel. Instead of using the channel and the overall impulse down, now I remember what this was. You notice on this impulse down, it didn't match up with anything. But if we ignore the channel and measure from the breakout point instead, look at that. We get a much better measurement. So if you see prices are moving alongside in a channel and we finally break out but start to correct again, instead of measuring the entire move down, go from the breakout point of the channel and you get a better number. As I already said, ignore the spikes. Don't use the big wicks like that. Use the open of the candle that started the move instead. You get a much better measurement. You can see it closed and opened pretty much at 38.2. It didn't hit exactly at the highs, but it was pretty close for the close and open. So now with the extensions, this is where you're measuring the next projection that's going to be happening in price, the new impulse that you're going to be trading. Where's your target going to be? I did that on gasoline today, right? You do use the extremes. You use the spikes on that one always. And you can add or subtract gaps. If a gap is going in the impulse, you actually have to add that extra movement. Okay? So you need 3 pivot levels. If you're projecting an impulse, a move up, you need 2 lows and a high, because you need to go from low to high to pull back to project. If you're making a decline, you have to have 2 highs and low. High to low, retracement, impulse down. So if you have a failure on a short-term projection, look at the bigger time frame, basically. The bigger time frames usually have precedence over the smaller ones anyway. But here's a couple of extension examples. You have an impulse down, in this case, correction up, and the new projection down, you can see, stalled out at 61.8. And you always go from highs to lows in this. Here we had an impulse up, correction down, and projection upwards. So let me go ahead and skip that. I'm just saying, actually, before I go any further, arcs and fans can be used, but they're not really a good method to use. So if we take a look at these Fibonacci extensions, there I'm going to go ahead and project high to low to retracement. And you can see this one actually hit 61.8. Look at that. Started correcting again. However, something that I mentioned earlier, you can see we continue to move down afterwards. I mentioned you should subtract or add the gap. The gap takes away from price action that should have been part of that impulse. So typically what you're supposed to be doing, if you want to be really accurate here, is take the distance of the gap and add it on to these extensions. So what do we have here? Let me go ahead and get a calculator up. There it is. We have 116.75, 115.08. And that is 1.67 extra. So right here we have 110.14 minus 1.67. That should be 108.47 is the actual projection number. Well, it didn't really help us in that case. As you can see, we were better off just using the correction at without measuring the gap. I'll be honest, I forgot about the gap thing. I haven't even used it. I've been using the projections without the gap. But we can take a look here, 108.07, because that's ultimately where we turned around. 108.07 minus, again, that 1.67, which is the gap, we have 106.40. So if I go to 106.40, look at that. It actually did work. Amazing. So the 100% extension of the prior impulse, if you took out the gap and added it at the end, gave you the exact end of the move. It worked. So I totally forgot about that, but we didn't work on the very first pause, but ultimately where the impulse ended, it actually worked. So let's see if we got another impulse and correction here that we can measure out. Tesla should, or no, this is ARC. I was thinking it's Tesla again. That should have a lot of impulses and corrections. And all right, here we got one. We actually have a couple gaps going on too. We have a couple, first of all, we have this impulse off the low right here, and we correct it down. Again, I go from the open of the candle to the high, and you can see we retraced 50%. Now we're impulsing back up again. So if I want to know where that impulse is going to end, I measure from the low to the high to the retracement point. I've got 61.8, 100%, 1.618. Again, I can use the 1.272 in there, which I didn't have, but it could be used as well. I'm just using the most common ones. But I got to remove the gaps. So once again, to get accuracy in here, I take the number of the gap and I'm going to remove it. We actually have two gaps right there we need to remove. That's it. Oh, that did not go right, did it? There it is. So what do we got? Bring up the calculator. 107.69, 107.18. It's 51 cents. And let me write these all down because I will forget. Dead pen. Let's try this one. Nice little fountain pen here. Okay. And the next gap, which is 111.20. 109, whoops, 94, 126. Yeah, this pen might be dying too. 126 and 51. So now what we have to do is on the projections, add in those gaps to get the actual projection numbers. Well, the first one is 109.76. Plus the first gap of 0.51 plus the second gap of 1.21 gives us, oh, I did that wrong. Anyway, let me just add these two together. 0.51 plus 1.21 is 172. So we add that to 109. Can't write today. 76, and that gives us 111.48. So if I go to 111.48 There's our first extension area, which doesn't look like it really worked at all, unfortunately, but hey, we might be going to the next one. So we'll clone this. There we are. And now we see 114.09. And we'll add in that gap measurement. 1.72 is 115.81. Close enough. There it is. And the next one, just in case, 116.77. 1.72, the gap is 118.49. So let me clone that one again. 118.49. I'll just go ahead and hit it in the settings. There we go, 49. Cool. So they are where they're supposed to be rather than with these projections. Actually, I'll leave those there for a moment. You can see we exceed the first projection, so we know that's not working. So our impulse might be going to the next one. And we gap beyond that. Remember, these are the actual extensions where they're supposed to be, minus the gap. And look at that, we stalled out there. I wouldn't necessarily say we've corrected, but yeah, it did halt. It just halt right in that area. And I guess we did have a little bit of correction, not much. But you can see that these are working better because we included the gaps on the impulses with and without. So my last little study here, again, going back to RBM 2022 and the 4-hour chart, you saw I used those Fibonacci's quite a bit, right? So let me go back again and redraw this. Oh, there we are. And what happened with that, we have our impulse up, correction down. You see we pulled back 50%. And then for the trade idea, we were looking to see where's this going to continue for our new impulse. Well, we have low to high to retracement value. No gaps on this because it's the futures, but we have possible probable targets for turning points in the future. Well, we're stalling out a little bit, not really turning around. We overshot this one. We may continue to go higher instead of pulling back for our entry. And if we do end up pulling back for our entry, I showed you where the targets would be based on not necessarily even the 4-hour chart, but going out to the daily to see the trend and impulses a little bit better. Notice when you go from the 4-hour time frame here, this doesn't look as much like an impulse because you got a lot of jaggedness here and even here. But when I go to the daily, it smooths it out. So I see the impulse is a little bit better right there. Correction, impulse. Impulse now, we're waiting for a correction. So that's a little bit more about how to use the Fibonacci. If you got more questions, message me, let me know. Hopefully you enjoyed the video. And if you did, please give it a like and subscribe so that way you can be there for the new videos coming up. Until next time, trade safe, trade well, and take care, everyone.